Hello and welcome to the Trading Bell. I'm Nokip Kimboy, and we're about to have a conversation over a drink, of course, of water, but we are talking about EABL's performance for the last financial year, 2022-2023. What are the dynamics? What actually impacted on their numbers? That will be critical. I'll be having this chat with the CFO, the one and only Risper Ohaga. Risper Ohaga is the Executive Director and Group CFO at East African Breweries PLC. Welcome to the Trading Bell.
Thank you very much.
Oh, so looking at the financial year 2022-2023, quite a dynamic year, but specifically for your industry, just to set the foundation, because we saw there was sort of a pivotal moment with COVID, and almost every sector had these massive changes that was instigated post-COVID and that post-COVID recovery. For your industry, generally speaking, what has that curve been in recovering from COVID?
I mean, 2020 and 2021 were tough years because for us, we are a very cash-rich business. So when people are out buying drinks, we make quite a lot of money. So with COVID came outlet closures. And with that, the financial year ended June 2020 and 2021 were muted in terms of performance. Sales dropped volume-wise, and at the same time we had excise increases. Following on that, F22, which is the year ended 2022, was a very successful year. We closed with 109.4 billion in sales, and we recorded our highest profit ever. For the last 7 or so years, despite excise increases. So I think the work we did during COVID, investing in capacity in Uganda and Tanzania, investing in sustainability of our plants, both in Kenya and Uganda, and also investing in our people. We didn't let anybody go, and instead we applied ourselves to finding new ways to capture the market, investing in e-commerce and the off-trade, to make sure that we were able to capitalize and emerge stronger when the pandemic ended. And that saw us land a very, very strong year ending 2022 with about 15.3 billion in profit after tax and 109.4 billion in sales. Now, coming into the year ended 30th June 2023, it's almost a year of two halves and impacted by many, many different things. So COVID was over, so it was a good time to springboard and grow even faster. However, we came into two excise increases, one in July of 2022, where we had a 20% increase in excise on spirits and 10% on beer. And then we had a further 5.9% increase in October, effective 1st October. And with that coming through, in addition to the effect of inflation and drought, we've had very, very serious shortages of grain following the East African drought, as well as ethanol, because the sugarcane growing and molasses availability was again disrupted. And with those coming on board, we were forced to take prices to cover the excise and inflation. And when we did take prices, we saw a decline in volumes, about 7% for the year. Yes. Mainly in Kenya, which was most impacted by particularly the excise increases. So half one, excise started to show up very strongly and started to impact volumes. At the same time, in half two, consumers really started to feel the impact of inflation. Inflation in double digits, both in Kenya and Uganda, remaining single digits in Tanzania, but the basic food basket was still in the double digits. So consumers were highly pressured and therefore prioritized their spending. And therefore their share of wallet that came into luxury items such as ours was significantly reduced, coming down 200 basis points from the previous pre-COVID period. So we had the combination of excise, inflation. On top of that, we had customers being impacted. And finally, the currency. Between June last year and this year, we had about 19% depreciation in the Kenya shilling. And on top of that, there was also the challenge of liquidity of foreign currencies. So where we cannot source products locally and we are forced to import things like ethanol or glass, when we do bring those in, and last year where there was shortage of liquidity, we were forced to borrow in foreign currency despite having the cash, just so that we could access the foreign currency to pay for our inputs. We're able to settle these positions this year. However, that came against a significant depreciation in currency of about 19%, and that showed through in the numbers. So quite a tough year, but also quite impressive. Areas like Uganda grew strongly at 17%. Areas such as the premium sector remained very resilient and also grew. But we saw that the middle and the lower segments are the ones that really struggled to sustain growth in this period. We also kept our costs low, but the impact of this headwinds was quite strong on our performance, and we came in flat on top line and 21% down on bottom line.
And I'm glad you've already set like the whole picture, sort of bird's eye view of how we've proceeded from a post-COVID recovery to where we are. Looking at the specifics, I know you mentioned the issue of profit after tax dropping 21%. One of the components that really impacted that, it was this issue of cost of sale. I realized that it went up 10% to almost 62 billion. And highly driven by depreciation and amortization at 20%, also raw materials and consumables at 15%. This issue of depreciation and amortization, maybe help us understand it a little bit more and how impactful it was on this issue of cost of sale.
Yeah, I mean, for us, investing in our business is very important. So when you look at the last few years, we've invested in the Kisumu Brewery, which we use for Senator. In F19 is when it came in line. And then we also invested in a brewery in Moshi, Tanzania. We've had a massive expansion there of about 7 billion shillings coming in line. And then in Uganda as well, we put in additional capacity. So investing in all of those areas is good for our future, because you have to invest to support the growth. And if you look at the classic example of Uganda, we've grown 30% in the COVID years, 19%, 17%, and that is backed by our investment in capacity. So investing in capacity is critical to a business like ours. Having said that, it is important to have policy certainty, because with policy certainty, then you can make such long-term decisions, because you know what kind of revenues you're likely to make and how to manage that. But the biggest impact on our numbers is really raw materials. So we had grain going up significantly, about 30%, ethanol about 61%, electricity, you will know, about 20%, and logistics and transport also about 21%. So all of that coming in this 1 year had quite a big impact, and we recorded about 9 billion worth of inflation in our cost of sales, of which we're able to offset 4.2 billion through our own initiatives, but the rest of it could not be fully offset, neither could we price it in, otherwise it would impact volumes significantly. So that really is the shape of our cost of sales. We do see some positivity with the rains having come in, availability of grain and the grain pricing has improved, so we are positive around that. And we also see in this year's finance bill, despite its current status, there isn't an increase in excise for this year, and the provision for an annual inflationary increase, which, to be fair, was it made this market quite uncompetitive, because then your cost of production was rising way faster than wages. So with that having been removed from this Finance Act, we see a lot of positive potential in the coming year. Yes.
And I'm glad you've mentioned that issue of certainty, because it becomes very critical. Especially the excise. It's always been one of those issues that it is a problem for many manufacturers. I'm taking a look at the East Africa region, the markets that you are in, Tanzania, Uganda. I mean, Tanzania grew 1%, Uganda 17%. Are there lessons, especially when it comes to setting up policy, that sort of we can learn from the dynamics based on the performance of the last 1 year that especially Kenya we can implement?
Certainly, and I would take the journey not just 1 year, but if you look at the last 3-4 years, those markets have been growing in double digits consistently. And what has been clear is the policy clarity. This year, Tanzania has taken an increase in excise, but that has been after 7 years of no increase, whilst Kenya excise has increased certainly every year, sometimes twice. So you can see the difference and the impact that has. And also, whilst Tanzania has increased this year, they've also pronounced that the next increase will be in 3 years' time. That allows you to plan, that allows consumer revenues to also grow, and therefore, as an investor, you do feel that the certainty does help you plan. For Uganda as well, they haven't pronounced themselves on exactly how frequent the increases will be, but again, they have not been as quick to implement increases as Kenya. I think there's some positivity with the tax policy that is being discussed, that there's been talk of creating that policy certainty in Kenya as well, and if that comes through, that will be a good thing.
Definitely. The tax policy, indeed, it will make a huge difference. In fact, I've been listening, especially in investor conferences, always that comes up, that certainty in the environment to be able to do business. You talked about borrowing.
Yes.
Borrowing is a crucial part of investment.
Yes.
Looking at your numbers, your borrowing went up, actually 34% to 58.5 billion. And I was looking at the breakdown of these. Especially non-current ones, which are a little bit long-term, 39% up, and bank loans, 57% jump in bank loans. And I'm juxtaposing this with the current regime that we are in, risk-based financing, interests have been going up. Is this the reason behind the 57% increase? Other than also the issue of borrowing in Forex?
So two things. One, we typically do not borrow in Forex. And I know when we went out to issue the MTN a few years ago, a few people asked me, why don't you issue this in foreign currency? It's way cheaper. And I said, if you don't have foreign currency flows coming in, then you create a very big Forex risk. And I think many have seen that come to bear. And so we generally, because we have a lot of our income in local currencies in the markets we operate, we do our borrowings in local currency. The only reason why we held foreign currency exposure was simply because of lack of liquidity of foreign currencies in our markets, and we've since extinguished that. So by the year end, we didn't hold any foreign currency exposure. Having said that, we've been on a journey to make sure that we match our funding to what the underlying asset being funded is. So whereas sometimes we've invested in capacity, which is 50-year investment type, we've put in own cash into that. We've been very clear that we want to fund long-term assets with long-term money, and so making sure that we match that so that the shape of our balance sheet is quite strong. And a big part of that was the 11 billion medium-term note that we issued. You'll remember 1225, which was fixed, which again, in the rising environment, that has helped us quite a bit. We also have some element of that funding which is fixed at quite some of it even in single digits, which again gives us a good mix of funding. The rest of it, particularly in this financial year, you will see we increased our borrowing by just about 12 billion, which is the amount of capex we spent. So again, to fund capex, we then tend to borrow. But how we look at our borrowing is we have a few key ratios, the most important being the net debt to EBITDA, which is where the board holds us to account. They typically require us to be in the region of 1.5 times. We're sitting at 1.6, which is slightly higher than where we would have wanted to be. So we are looking at reducing that. But I think if you look back at the COVID years, we stood at 2.1. So we've been able to bring that back nicely to 1.2 in F22 and now to 1.6, and seeing how we bring that back in line. Also, if you look at our current ratio, it's sitting comfortably above 1. So those are things that we look at our balance sheet strength from that lens and make sure that it's sitting well for us. So again, as you say, as rates are rising, it's something that we're very keen on deleveraging. I think we're positive in the outer years. We can't always say, given how dynamic the environment is, but a key priority is obviously to manage the debt level to a lower level. I think that will be a key priority over the next few years.
Definitely.
Yeah.
Very important. In terms of the note that you issued, I mean, raising capital, especially using debt instruments in the local market.
Yeah.
I'm very curious to see, because it's not something that happens that often.
Yeah.
Yeah. I'm very curious to see, are there lessons that you've learned in terms of the dynamics of this market that even people who intend to do that could learn from this particular move that you've done?
Yeah, I mean, I think it's an intensive exercise raising funding, as it should be. It's quite an intensive and prolonged exercise of going through governance and regulations to get all your paperwork in order. But I think the capital market does offer quite a good source of investment, especially for long-term funding. And if you're of a size such as us, you very quickly get to single borrower limit with most of your banks, and unless you now bank with every single bank in town, which again becomes really challenging, it is so much easier to go into the capital market and give yourself headroom with the banks so that when you do need short-term funding, then you can still go back to them. So it was good in terms of providing that long-term funding. It was good also to engage with the different players and to gauge how they think about pricing. I think one of the things that was clear to me is we have to get better at risk-based pricing, so pricing for the risk as opposed to chasing for the yield. Because if you chase for the yield and you don't price in the risk, then you could go very wrong. But if you fully understand the company, you fully understand their numbers, you fully understand who's behind them, and you fully understand their cash flows, then the pricing should really get a lot finer in this market, because the capital market should not offer you a much higher price than the banks do. The banks offer you a lower price because they know you. So I think getting the analysts to really get to that level of depth of intimacy, of understanding the different businesses will make it a more viable avenue for fundraising and for investment on the other side. Definitely. So I think it's very viable. I think our capital markets is a viable one. As we saw, we got such a major oversubscription at 12.25, which by now looks like, wow, that
I know
that was quite a good deal. Yeah, but also it's being clear around understanding the market, understanding where rates are likely to go. At the time, we were compelled that rates would be rising. Not everyone was sure of that, but taking a bet on that and saying we do believe rates will rise, and what's that sweet spot where if we're able to compensate for that premium that people will need to be compensated for to hold their money for 5 years at a fixed rate, then if you land the right price, then it's a win-win on all sides. So I think just understanding how to price, understanding the different players, pricing for risk, and just also understanding the level of liquidity so that you know where to place your pricing are really important takeaways from that process.
Definitely. In regards to the market and borrowing from the local market, especially as a private sector player, is it a concern when you see the kind of risks that we are having? I know based on the comparison, you guys with your paper, you've gained. But in terms of the current people who want to go to the market and competing against maybe government papers, is it a concern as a private sector player?
Yeah, definitely. Because when you think about it, government borrowing at 16%, which investments can you earn 16% and above? There's very little. So people then tend to default to government security because it's an easy picking. And you see that affecting our stock market on the share side, on the equities side. Because if you look at the yields over time, government securities in our market have tended to be much higher than the yields from equities. And so there has been a preference for debt over equities. So a lot of the counters are significantly undervalued as a result of just that conundrum. Having said that, I think government has to do what government needs to do.
Definitely.
And I think there are cycles as well. I mean, we've had seasons where the rates were as high as 30, they've come down to single digits, and one just has to be very, very smart around how you go about fundraising, at what level. And also with each of these, you always look at signing into contracts where you have the flexibility to act if you find that the rates are going out of range, where it's above your earning capacity, or where you just need to restructure in order to protect your balance sheet and also your P&L.
Definitely. It's very important to note. Businesses, the fuel behind businesses are people, and that is your consumers. We've talked about inflation, which has been kind of crazy. Looking at the numbers for last month, I think Central Bank was very proud, saying, now we are within the target range. Inflation is at 7.3% in the country. But the evolution of the consumer, how has your consumer changed, especially observing this particular last financial year and within these 3 different markets that you operate in?
I mean, it's been tough all around. And I don't think it's just an East Africa or a Kenya matter. Economies are generally going through recession and really challenging times. So inflation is high, rates are high, currencies in emerging markets are devaluing, and you see subsidies being lifted, and therefore costs are just generally really, really high. And then when you add in the weather patterns, for us having gone through a drought last year, that really made basics of food items quite expensive for consumers. And so we will have seen in our presentation that previously your typical consumer spent about 7% of their wallet on our products, and this has come down to 5% in this last year. So you can see the strain the consumers are taking as a result of inflation, and that also translates into their salaries are not growing at the same rate as inflation. I don't know anybody that's earned 10% and 7% over the last 2 or 3 years. And so the managing of inflation is really critical, and also just allowing incomes to rise to meet up with the cost of goods is really important as well. So we've seen certain segments are resilient. We've seen certain segments struggle. We've also seen areas where we can bring in more efficiencies to cushion the customer, and that's what we're constantly working with across all the 3 markets to make sure that we are able to deliver a strong performance.
That's very important. For malleability of the consumer in terms of how they change from a product to the other when the external factors kick in. Are you able to note movement maybe, or there is that loyalty to particular products? Is there that dynamism?
I think there's a bit of both. The biggest impact, particularly when there's inflationary pressure on the lower segments, that they tend to drop off into illicit. So they will drink stuff that they don't know what it's made of, they don't know whether it's healthy, and they have to drink it in circumstances that are quite unsafe for them. And therefore also, again, when you come to the policy discussions with the policymakers, that pushing pricing so high or taxes so high that people fall into illicit is not helpful for the consumer, neither is it helpful for government, because then they don't get any taxes either. So a big part is really working with government and policymakers to ensure that these issues are addressed. The access to illicit and the ability to benefit from illicit, but also the managing of the tax bracket so that the safe products are not out of range, because anything lower than what we are paying, you really won't be paying taxes, and we don't want to do that.
Definitely. Briefly, let's touch on investors put in money and they want to make money. So dividends come in very handy, and I don't know whether there is that understanding of the environment that you operate in, or when you see your dividends from the previous financial year dropping from 11 shillings to almost 5 shillings 50 cents? Is it something that it has sunk with the investors? What are they voicing to the CFO?
I think the feedback has been supportive. One, because they recognize the volatility in the environment, and the way, the current environment means that you need to conserve cash, so they get that. Secondly, also looking at the level of our balance sheet and how much debt we're holding, they also realize that keeping cash to reduce that debt is an important thing. Thirdly, a majority of our investors are in it for the long term. So they're not just looking at this year and this dividend, they're saying, what's this business doing? What's their strategy? What decisions have they made, and how are those panning out? And are we still confident in their strategy? And when we engage with them, I think they really understand the decisions we're making, the investments we're placing, the returns we intend to bring, and that, it is a long-term decision. Investing, certainly in our continent and in our part of the world, is never a one-year journey. It's always about thinking long-term and saying, what do I see in this company? Are they making the right decisions? Because we could well borrow from the banks and pay a big dividend, but then that would wreck our balance sheet, and it would destroy any chances of us being successful in the future.
Okay. And lastly, talking about the future, now in the new financial year, a lot is changing, a lot of moving parts. And I'm looking at this industry and the markets that you operate in. What do you think will be the biggest components that we need to watch out for this financial year?
I mean, there's a lot. I think certainly what I've said around the re-emergence of illicit is one that policy needs to really come in to address, both for the safety of the consumer and also for government's own income levels. I think they do need to look at that. Secondly, taxation and taxation policy. Yes, we've gotten reprieve through the current Finance Act in Kenya. We have some clarity around Tanzania, and Uganda has generally been quite stable. But I think there's still a need to really explore the subject of taxation, and when you start to get diminishing returns, particularly for a sector like ours. I think that's one that we continue to think about and to discuss. The third thing is just around, and this is big for us, consumer awareness, trends and developments. And despite there being real hardship, there's also real pockets of opportunity. And you'll see we've just recently launched tequila in Kenya, and we'll be doing so across East Africa. There's still quite a lot of pockets where exciting things are happening. We've just put out a microbrewery, which enables us to do quite a lot of things more creatively and in a more agile manner. So again, thinking about things like those, and then also thinking about our channels, e-commerce, and continue to build on what we've been doing since COVID began, and capitalizing on that. But still on a macro level, I think we probably will still go through a bit of a challenging time. Interest rates are still likely to rise. Currencies are still under pressure, so we're not out of that yet. But I think our confidence is that economies go through cycles, and you need to ride through the cycle and come out having made the right decisions so that you can thrive when the cycles turn around.
Definitely. As you've said, you are in this for the long run. You're playing the long game, which is very important.
Yes.
Risper, really appreciate your input in this conversation. Risper Ohaga is the Executive Director and Group Chief Financial Officer, East African Breweries PLC. And she says that as much as the environment is changing, but also we are not yet out of the woods. So still need to have our belts on. But the market, there are opportunities in this market, which is very critical, and they're exploring, sticking to strategy, but exploring options that are there to make sure that they're thriving. Well, that's the latest from EABL. I'm Rocky Kimboy, and I live with the markets.